Hi, can everyone hear me okay? This is Bronwen Madden from the El Camino College Center for International Trade Development and the Small Business Development Center. We're pleased to have this webinar with you today on the IC DISC Export Incentive. We're also partnering with the District Export Council of Southern California and TRCG Advisors. We have a few housekeeping slides that we're going to go over before we get started officially. As everyone probably already realizes, the phone is muted, so we will open the phone line after the presentation is over. In the meantime, if you have a question, you can submit it through the chat window. Okay, so we'll go over questions in order that are submitted through the chat window, then people can raise their hand, and then we'll open up the phone lines. Okay, you can listen. There are two options. You can call in and listen through the phone, or you can also listen through your computer. And this is basically what the chat window looks like. So if you want to submit messages, you can click Send to the Room, and we'll all see your question. So I'm going to turn it over to Steve Ragau. Steve is a certified public accountant, and this is his expertise. Thank you.
Good morning, everyone. At least I say good morning if you're on the East Coast or Midwest. I'll say good afternoon. What I'd like to do today is pretty much create more of an understanding of this tax strategy, IC DISC, and how it can benefit people involved in various aspects of the exporting business. It is a very viable strategy, very beneficial to many people, and what I want to do today is start to cover the basically what is the DISC, who qualifies and how they qualify, how it works, give you an example of a benefit, and then talk about certain key points of interest. With regards to the questions, again, as Bronwen mentioned, some of the questions may be complex, and what we really want to do is we will create a written document with every question and every answer and send that out to everybody registered with the webinar. What we'll try and do today, depending on time, will be to address some of the more simple questions if there are some. And then we'll talk about an assessment. Let's talk about what is an IC DISC. As I mentioned, it is basically a tax strategy. The DISC is basically a paper entity. It functions as a commissioned agent for the entity that's doing business, and through this commission agent, it enables the business person to treat 1/2 of the profits from their foreign revenues as a dividend. Dividends are taxed currently at 15%. So if you look at the current tax rate that you're at, when most people are at, most businesses are at a 35% tax rate, the owners, that is a 20% reduction in the tax liability. Quite an interesting and beneficial opportunity available to U.S. companies engaged in the export of goods and services. When we talk about who qualifies for the DISC, and this is a little bit more important, if you are any kind of a manufacturer, you qualify. You're in the agribusiness, you qualify. If you are in certain areas of services, like architects who draw plans for building cities or structures in foreign countries, or you're an environmental engineering service where you're planning some treatment for soil or water in a foreign country, those services qualify as an export service. If you acquire certain raw materials or subcomponents from foreign countries or foreign sources, but add substantial value, usually 40-50% or more, back to the product, the finished product, and then sell it to foreign entities, that constitutes as a qualified export activity for the disc. Recycled waste falls into that category very strongly. So not only are these different products involved and businesses involved in export activity, but in certain cases, rent for equipment that's needed to support some of the efforts that are being used, or maintenance and support contracts to support the products that are being sold, also count as the additional revenue that's calculated for the benefit of the disc. So all of those businesses engaged in those activities that I've just outlined qualify. I've also mentioned the middleman activities, as you see next on the slide. If you are a manufacturer or you've enhanced product and you sell your product to a distributor or someone in international trade who then in turn sells the product overseas, both entities are capable of taking the benefit. The key here is, as the manufacturer, you have developed product that is destined for overseas location and placement, and the middleman, the distributor in this case, served the function of selling to a foreign location. Both entities qualify for the calculation benefit from the disc. As I mentioned before, with the substantial product enhancement capability, it doesn't matter if you are buying raw materials or subcomponents from a foreign entity and then making a finished product. The key here is how much effort and how much value you are adding to that finished product. And typically, it's in the range of 50% or more. If you're adding that much value to a raw material or subcomponent in creating a finished good that you're selling overseas, then you qualify for the disc benefit as well. I have a short slide where I have also identified some of the industries that qualify. So that you'll have as an example. The next question that comes up is, what do you need to do to qualify? Now, this is where a lot of questions will come up, and sometimes it can be a little complex, and I'm going to go through it simply here and address a lot of the complexities and some of the questions that we respond to, or I know in advance, and I'll put on that document that we're going to send out to everybody. But essentially, if you are a U.S.-owned company, whether you be a C Corp, S Corp, LLC, we just have to set up a separate entity called the disc entity. And as you can see from the slide, there's a treatment that differs whether you're an S Corp, a partnership LLC, or a C Corp. Essentially, a separate entity called the disc entity is set up. What's involved in that process is basically, as any other corporation is set up, you've got your papers of incorporation, the elections that the executives and owners have been identified and say, we elect to have a disc, we elect the disc to be a commission agent that will be handling the international transactions, and we elect it to pay back our dividends. Essentially, setting up the separate disc entity is fairly easy. The reason you set up a separate entity is that there are certain requirements that have to be met as a functioning commission agent. It has to be contained mostly of foreign gross receipt sales activity. The assets that are in there must be made up of what they call qualified export assets. It must be dealing with the property that is considered meeting a manufacturing test. So essentially, you could take your own existing entity and make it a disc entity, but then you run the risk of saying my one business will fall out of meeting those test requirements. So it usually pays to set up a separate entity, and it doesn't have any impact on the business. It's just a matter of how the dollars flow and the credits are calculated, and I'll show you an example later. Where this becomes a critical issue, and as I point out, there'll be a later slide where we talk about it, is if the entity involved in the business of exporting is either foreign-owned, it's a U.S. subsidiary of a foreign-owned business, or has some combination of foreign ownership involved with it. Then you start to run into a certain amount of detailed analysis that has to be made to look at, are there any tax treaty issues involved? Are there any foreign tax benefit issues involved? And is one impacting another? And the analysis that's usually done up front will determine if there is impact and what the value of that impact, the cost of that impact is, and where is it more beneficial. Sometimes you may have a company that will qualify as a DISC, but their foreign tax benefits outweigh the benefit from the DISC, so it's best to leave it alone and not do anything. Other times it might be, even though there's an impact on the foreign tax issue, the benefit from the DISC might be better. The analysis will show that, and that will be a decision that will be made by the business owner along with his CPA. Let's talk for a little bit about the DISC calculation. As I mentioned earlier, the DISC is a strategy that focuses on the benefit you get from handling the foreign sales transactions and calculating the benefit from the net profits of those foreign sales. There are essentially two methods of calculation. One is a very simple method. You basically just take 4% of the gross foreign revenues and treat that as your net foreign income. The second method is you actually do a detailed review of all of the foreign transactions and calculate the net profit from those transactions, and then take 50% of the resulting net profit, and that gets used for the calculation of the benefit. Now, you'll see shortly the example that illustrates this, but typically, as you'll see, the simple method works well when you have lots and lots and lots of invoices, one product, one basic simple margin calculation, but a very small margin. It is not worth the effort to go through, let's say, thousands of invoices when you basically know I have a very low margin, I have one product I'm selling, I know what it is, it's easier to do that calculation. But in many cases, clients have multiple product lines that they're selling. The product lines have various margins attached to them, and the effort involved in detailing that breakdown out usually will result in much more benefit and credit coming back to the client. And I'll show you that now. This slide that I'm showing you now illustrates an example where a company has foreign sales of 10 million, basically a resulting net income of $1 million. Without the first column of numbers is the calculation of their tax liability without the DISC. $1 million of net income at a 35% tax rate, $350,000 in tax paid. The next column is with the DISC. The net income of $1 million, half of it can be treated as a DISC benefit and half not. So half of it is still subject to the 35% tax. That's $175,000, but half of it is treated as a dividend. And essentially what happened here is the business entity made a $500,000 payment to the DISC entity as a commission expense. So they actually had an expense on their end, which helps them even more, and it's not in this calculation, but that shows up as an expense on their side. The DISC entity reimburses the owners with the $500,000 at a dividend rate of 15%, tax $75,000. So the net result is basically a $100,000 tax savings using the detailed calculation. The next slide takes the same example and shows the calculation where we just used the 4% of gross sales, of gross revenues, foreign revenues, as the DISC benefit. And as a result, there was only an $80,000 savings, which was $20,000 less than the benefit beforehand. This is just a simple explanation. As you'll see on one of the final slides, there is a set of information that can be requested that can give a very quick, beneficial outline to anybody who wants to know what potentially they're looking at. But typically it is in the early stages of a review where the entity setup is being reviewed and this detailed analysis is being made to come out with the pros and cons of both ways. The analysis is done both ways to offer the client which choice is better for them. But this example will show you that in many cases, the detailed approach is going to be more valuable to a client than the simple approach. As I mentioned earlier, there are some key questions that need to be considered here. I'm going to mention them briefly, and as I said, I will provide detailed answers to these in the write-up. Obviously, as I mentioned, one issue is the calculation, and usually when a company expresses an interest in the DISC, a review is made up front to determine what is the best approach for them to take, simple method or detailed method of calculation. The entity structure is one that does need review. Obviously, if they are a straight U.S.-owned corporation, no other foreign implications, then it becomes very easy to approach. It's just a matter of knowing whether they are an S-Corp, LLC, or partnership, or are they a C-Corp. If there is foreign ownership involved in any way, a review needs to be made and a discussion needs to be had with the CPA and the tax attorneys to determine where any impact is with foreign tax benefits and treaties or not, and which is the best way to go, or leave it alone with the client. There is a question that has come up in the past. What if the DISC goes away or the tax rate changes? And right now there is a discussion underway that possibly in 2013 the dividend rate will go away. There'll be no more 15% dividend rate on the available. No one knows for sure where these tax discussions are going to end up. It's possible that nothing will change. There's been some discussion that the dividend rate will be raised from 15 to 20%, but that the tax rate will go up from 35 to 40. And if that happens, there still is a 20% differential savings to a client. It's possible that the dividend rate can go away totally. It's not uncommon to see that sometimes when certain tax situations are eliminated, others tend to replace them. There is a big move on to increase exports, and it's my personal belief that as long as that item is still hot at hand, something will be there. But regardless of what happens, the strategic benefit available to a client is available to them through the balance of this year and all of next year, and in many cases can be substantial enough to still warrant very serious consideration as a tax strategy for a small and mid-sized businessman. So those questions I will detail more as we go forward. I'm sure people have some questions today. Hopefully you either will email them in, and I will open up shortly if there's some short ones to answer, but for the most part, if they're complex, it'd be much easier to address them in a written document that we will send back. The only thing I do want to summarize is that this is a very strong, viable benefit to consider for the balance of this year and next year. And you can either call in or send in the information to Bronwen at El Camino, but the final slide does contain a lot of information that if you send that information in, at least some preliminary beneficial outline can be provided to you as to what dollar benefit might you be looking at. And I thank you, and we'll open it up for some questions if we can. Thank you.
Okay, I just want to let everyone know this is one of a two-part series. We will be having another webinar on the R&D tax credit coming up in the next couple months. So I'll follow up and let you know when the date and time will be for that. So now, since I don't see any questions typed in, I'm going to open the phone lines, and you can ask questions.
All attendees have been unmuted.
Have any questions? Okay, we have one from John. Will copies of the presentation be available to attendees? Yes, it will be. I think that you can download it from this site, but we can also email it directly. I will do that later today. And then we have a hand raised. I think we have 9 people with their hand raised, but I don't see the hand. Feel free to ask your question because I don't see the order of the hand raises on here.
Anybody have a question?
I have a question.
Okay.
I missed part of the presentation or the majority. Is there any way that you recorded this where I can access it?
Yes, we did.
It is recorded. I will also email the link.
That will be wonderful. Thank you.
There's a question from Daryl. In the detailed method. In the detailed method, the cost of goods sold.
The cost of goods sold total for the company or specific for the foreign product. It's usually specific for the foreign sale. The margins selling to the foreign locations could be different than the margins being sold here. And we want to take advantage of the best margin possible. So we don't just make an assumption of a margin across the board and say it's X. In the cases I've dealt with, I've seen companies who have higher margins selling overseas than they do here. And as long as we can establish that model in support of that, we can take the higher margin. I hope that answered your question.
And you guys can speak up. You don't have to be shy on the phone.
Yeah.
Kostra has the next question.
If you are brokering transactions, you can qualify. As I said earlier in the presentation, if you are what I call the middleman, you have obtained goods or from the manufacturer, and then you in turn are brokering and selling them overseas. You're in the middle, but you are involved in the transaction. You can take the credit as well as the manufacturer can. Lance, hold on 1 second. That question I'll detail in an answer back, Lance. That's going to be that's one of the questions that come up typically that we review in detail because we don't want to set up any structure that, and we would advise any client, don't have a structure set up that impacts the current structure you're in. I think you'll be okay there with that, but I will answer that directly in writing and get back to you. Kasra, in all cases, your current business can be changed to a DISC. The reason we suggest that you consider setting up a separate DISC is that there are certain requirements for a DISC to be in place, and those requirements are there's certain asset values and certain product marketing values that go through it. And it's not untypical that if you change your current business to a DISC, the domestic activity alone could be enough value that it will take away or detract from the values you have to reach to make your DISC effective. When we set up the separate DISC, it just is only on the foreign activity, and there's never any issue of it qualifying. The setup is very easy, and it's not very costly. It's a one-time, it's a very small charge, but it is recommended that that's the way to go.
So does the foreign content in there sort of impact?
The foreign content, John, as long as, it doesn't matter if there's foreign content in the product, as long as the U.S. company has added substantial value back to that content before it is sold overseas. Substantial could be in the 40-50% range or more. But so I could buy, I've got one client that is buying subcomponents from Japan and then actually making the product from here and then selling it all over. But they very easily could establish that they've added like 60 or more % value with the finished product compared to the subcomponent they bought.
What do you see the value requirements are for an ICD?
I'm not sure. Kasser, I'm not sure I understand. If you're looking for the value requirement for a DISC, there is no value requirement. If I understand your question correctly, there's no minimum. The question becomes, if we take half of the profits of your foreign sales activity and calculate the benefit, is the benefit going to be enough to offset some costs that are involved? And here's a good example. Let's assume, for argument's sake, that you have I'm going to make up a number for qualification here. You have a one-time charge of $2,500 to set up a DISC entity, and you have a $6,000 charge annually to pay for the DISC, but you have all that you have is basically $100,000 in credit, in profit from foreign sales. So if I take half of that, that's $50,000. If I take a 20% tax savings on that, well, I saved 10, but it's costing me like $8,500. You sit there and you go, is it worth it? Whereas I do have some cases where I have small clients that are in the, there may be 2-3 million in revenue or 5 million in revenue, but 60-70% of their revenue is going overseas. Half of that profit, when they calculate their profit and take half of it, even if they were looking at a $40,000-$50,000 tax reduction, that's substantial to them as a small business person. So I think here it's not so much, there aren't any dollar limitations to deal with as much as it is evaluating what is the actual benefit to you and is it worth it. And that's done in the preliminary analysis, and that's usually done at no cost. To at least let a client know there is at least substantial value to move forward in some direction or not, or there's very little value or there are other implications and it's not worth pursuing. I hope that answers it, and if it doesn't, if there's still questions, you can keep sending them in, or we definitely will do a more detailed write-up. Basically, improving a foreign sale, you might have an invoice to a foreign customer. You might have a bill of lading to show that your products went overseas, or you might be selling to a brokerage house, and the brokerage house has the documentation to show the product went overseas. Usually there will be some model that we create with some internal paperwork and documentation to prove the margin calculation. But it's usually, that part is pretty easy, and then once we go, then it's a matter of going through the different invoices to establish the value that's going to be transferred to the disk. I will tell you this much. While the benefit itself, from a tax standpoint, is analyzed, obviously annually, in many cases the analysis is done quarterly. While you don't necessarily have a tax return filed quarterly, many companies have quarterly estimated tax payments, and they will use the benefit calculated as a means of also reducing some of their estimated tax payments. So it's not uncommon to see where, in our case, where we're helping clients analyze the benefit calculation on a quarterly basis, and on an annual basis we give the complete summary and the appropriate paperwork to the CPA to file the appropriate tax return information. The setup for a disk is not, I say it's not expensive because it's going to be all relative to the value. Obviously, in the example I said earlier, if it was only going to be a $10,000 value compared to an $8,000 cost overall, not worth it. It's typical that I've seen disks set up for as low as $1,500, $2,000. I've never seen one more than 4 or 5. It's usually going to be in a range from 2 to 5, somewhere in there, depending on some complexities or, in some cases, very simple and minimal effort. For a small company, again, if we get into the profit calculation, you can use a standard cost, but it might be, again, it's going to depend on where is it advantageous. If you have a single product line, and that product line has a pretty standard margin, things are just basically made and sold similar way, standard cost can be used, and you just have to show the one example, and we can use standard cost on every invoice. And in those cases, we will probably also be using the simple calculation method. There is one client that I have that manufactures 4 different product lines, and those 4 different product lines not only have 4 different margin calculations, but one of the product lines has different calculations for sub-products within the line. So there, we really go through a detailed analysis by group, and we will look at more of a cost factor and some other factors that allow us to maximize the margin area on certain product lines and increase the benefit for the client. Again, this is all discussed in the initial and determined in the initial review period. The cost, there's a one-time cost to set up the disk. There's an annual cost for the associated assistance in calculating and supporting the calculation to the IRS. The IRS requires that it be a fixed fee. There can be no contingency fee. So typically what happens is there's a preliminary analysis for value and qualifications to set up the structure, and then the client is presented with the one-time cost for the disk and the fixed fee to operate the disk. The fixed fee then will probably be billed quarterly, broken down into a quarterly basis, but you will be presented with a fixed fee compared to the value that you're looking at. But it is an annual cost to ongoingly support the disk. It could qualify, and you'd have to prove it by showing that the product that you sold to that client was in, they have the bill of lading to show that it was sold overseas. And that's typically what we'll do with in a lot of cases with the middlemen, where they show that they had the invoice to show that they support the purchase of the product from you, and they have the bill of lading to prove that those products then in turn were destined for overseas delivery. That's correct. The cost of the disk, or the fixed fee, is usually, it's looked at the two ways. We're looking at the complexity of the calculation. Obviously, if you're using the simple method, there's not that much effort involved because we're not going through thousands of invoices. But if we're using the detailed method, it'll be a combination of the complexity and the volume of work that's involved. There are some clients that start off small, but then grow to 3-4 times their size. The fixed fee that is presented to a client, it's presented as an annual contract, so that no matter how much you grow during the year, nothing will change. But that contract then will be reviewed the following year. If you really increase, there's a lot more work, the fee might go up. If your business has dropped down, that fee could go down as well. But it is an annual contract that is presented to the client. And the annual cost, as I said, that's going to vary depending on the complexity and the volume of transactions. It's not uncommon to see companies getting back, six-figure credit, and I would say if you use a 15% of the benefit as a kind of like a standard norm, sometimes it's a little bit more depending on some complexity, but typically it'll fall in that range. What we will do is I will take the questions that came in just now. They will be repeated in the document, as well as other questions that I know I'm aware of that have been asked, and we'll put together a written document, send it out to everybody. Also, as Bronwen said, the presentation is available to people, and they'll be sent out, and they'll also be provided with a link if they want to listen to the presentation again. I thank you, and feel free to contact Bronwen later if any questions come up after the fact. Thank you.